Modern financial markets offer a wide range of different instruments designed to manage risks and optimize investment strategies. Among them, forwards and futures are two types of derivative financial instruments that allow market participants to fix the price of an asset in the future. And thanks to this feature, these instruments are widely used in various sectors of the economy to hedge risks. For example, the same farmer can enter into a forward contract to sell his products at a fixed price to protect against falling market prices. Similarly, an airline can use fuel futures to protect against rising oil prices. Now let's figure out what forwards and futures are and how they differ from each other. At first glance, these are absolutely identical financial instruments. Forwards, like futures, are contracts between two parties where one party is the buyer and agrees to purchase an asset, and the other is the seller and agrees to sell a certain asset at a predetermined price on a certain date in the future. The obligation to fulfill one's part of the contract is binding, even if it results in a loss for one party. However, there are differences between these contracts. The first difference is standardization. Forwards are created separately for each transaction. The parties can agree on any terms, including volume, price, and expiration date. This makes forwards more flexible, but on the other hand, makes them less liquid. For example, an importer will need to buy 200,000 euros in 6 months to purchase equipment. However, he does not know what the exchange rate will be in 6 months. It may increase or decrease. If the exchange rate increases, then in order to buy this currency, he will have to pay more dollars. Therefore, he can find an exporter to whom he will need to sell the currency in 6 months, and they can agree to conclude a forward contract where the exporter will sell this currency at a pre-agreed price. Futures are standardized in terms of contract size, expiration date, and other terms. For example, the Chicago Mercantile Exchange, which first launched futures trading, is now the world's largest currency futures market. And there, the size of a futures contract for the euro to US dollar currency pair is 125,000 euros, with an expiration date in the middle of each month. At the same time, the disadvantage of futures is that they are not as flexible as forwards. Nevertheless, it is precisely such standardized sizes that allow you to create liquidity that fully compensates for the lack of flexibility. This leads to the second difference. Liquidity futures are highly liquid because they are traded on an exchange. The main reason for this liquidity is that traders can use futures not only for hedging, but also for speculation, thus creating liquidity. And for other market participants, this means that they can easily buy and sell futures contracts. Another characteristic of futures liquidity is that their price may differ from the price of the underlying asset. If futures are traded at a premium to the price of the underlying asset, this situation is called contango. If at a discount, then backwardation. Forwards are less liquid since they are private agreements between two parties. Theoretically, a forward can also be sold, but it will be very difficult. First, you need to find another party who is interested in both the amount of currency specified in the contract and the maturity date. And the main difficulty of this procedure is that you need to call potential buyers and find out whether you need to transfer it to them. And secondly, such specific conditions create difficulties with selling this forward to other participants. The third difference is risks. One of the main risks of forwards is counterparty risk, the risk that one of the parties will not fulfill their obligations under the contract. Since forwards are not regulated by exchanges, there is no mechanism to protect against this risk. Futures reduce counterparty risk because the exchange is the guarantor of the transaction. And in order to ensure that these obligations are met, the exchange requires traders to deposit a certain amount of collateral margin. The fourth difference is speculation. If a forward is mainly used as a hedging instrument in the main activity, then the liquidity of futures allows it to be used as a tool for speculation, which in turn creates liquidity in the market. For example, a trader may believe that the price of oil will increase in the coming months, so he can buy a futures contract for Brent oil. And if his forecast is correct and the price increases, then the trader can sell the contract at a profit. Maybe someone remembers how a few years ago, a funny situation arose in the oil market when oil prices fell below zero. In fact, prices fell not on the oil itself, but on the futures. And such an absurd situation arose for the following reasons. Then, the maturity date of the futures was approaching, and at that time, by coincidence, there were no oil storage facilities. And traders who could not find these physical oil storage facilities did not want to engage in physical delivery of oil. That's why they were even willing to pay extra to have these futures taken away from them, and that's why prices went into the red. But still, such situations are most likely exceptions to the rules. And from here comes the last difference between futures, which is that they can be deliverable or settlement. Deliverable is when the seller is obliged to deliver physical goods, and settlement is when mutual settlements take place instead of delivering goods.